And Blake, if you want to go ahead and get kicked off with the macro, we can get going.
Yeah, sure. Kind of like you said, I thought it was a remotely quiet week. That being said, it's just coming off last week where we had the Fed meeting, so it was definitely some interesting things going on. I think kind of the bigger stories came from across the pond in the UK. And on Monday, we saw that breakdown of the pound against the dollar, and the euro was in the same boat as well, which came alongside news of just severely weakening economic conditions in the UK and the EU. So that kind of stemmed from the release of a new data point for a metric we call the PMI, which is the Purchasing Managers Index. So for maybe people who don't know, the Purchasing Managers Index is essentially like a survey of sentiment from purchasing managers in the manufacturing industry. So generally speaking, when these purchasing managers are feeling bullish, if you will, or sentiment's improving, you're generally seeing improving economic conditions. So you're seeing higher aggregate demand, and you're seeing more liquidity in the markets, things like that. And obviously, when you're in a declining PMI environment, it would be the opposite, and that normally coincides with contractions of economic activity, which if deep enough, could be labeled a recession. So on Monday, we saw the announcement of the Eurozone PMI, which is looking at PMIs across the European continent, and you're just seeing a decline, or an increasingly aggressive decline in economic conditions over there. So that kind of triggered some of the breakdown that we're seeing in Europe this week. So you had, on Monday following this report, you have, yields spiking in the UK and in the EU and in European countries. And then you saw that major decline of the pound and the euro against the dollar. And I thought what was interesting, just a kind of statistic that I think fit in here, I saw that global bonds are on track for their worst year since 1949, which I found super interesting. And this kind of, all of those factors led to Wednesday, which was the big story this week, which was kind of the moment we've all been waiting for, was which central bank is going to be the first to give up and reverse course and pivot back to an easing cycle, and that was the Bank of England. So I think it's pretty interesting. I would say it's almost funny, but I think like the consequences of it are potentially not very funny. But it was, I think the main key is that you're in a extremely inflationary environment. And at least in the US, I would say the majority of this inflation comes from an over aggressive Fed, a QE cycle that was too long and too aggressive. So the fact that, a country like England or the UK is going to reverse course and head back into inflationary monetary policy in the midst of an inflationary environment is doesn't make a whole lot of sense. Obviously, they're trying to save the treasury market, because as we talked about, some of their yield dynamics this week were pretty wonky, but they're it's just super interesting, and it's kind of counterintuitive. So I think coming from the U.S. and I'm in the U.S., so I think it gives Powell almost like a guinea pig. It's kind of the way I was thinking about it. And obviously everyone in the U.S., or I'd say a lot of people, are talking about is the Fed going to reverse course, or when is the Fed going to reverse course? It seems when is kind of been the answer that everyone, or the question that is everyone's asking. I think that looking at BOE now, or just looking at the UK in general, kind of gives the Fed a glimpse into what could potentially happen if you reverse back to inflationary monetary policy too early, or is it going to be that the effects are not as bad as everyone thinks? So I just think it's definitely going to be interesting to watch. I included a chart of GILS, which is an ETF tracking UK or just government bonds. I think that's a good way to track just what's going on from a pretty broad perspective over there. So moving on to kind of more U.S. based things, you have the 30-year average mortgage rate in the U.S. spiking this week. Yesterday it was at 6.7%, which is the highest that it's been since July of 2006. So that was obviously before the decline in rates from the subprime mortgage crisis of 2007, which I thought was super interesting. And I think that rates are the same level they were 16 years ago. That's without mentioning the fact that the average price of a home in the U.S. is now almost double what it was in 2006. So, even though your rate's the same, your interest payment is double. And I think, with that, we're starting to see the effects of higher rates spill over into the prices of homes for the first time. So you have the Case-Shiller index, which is, maybe the most widely used or respected metric for measuring the prices of homes in the U.S. And I think, obviously it's worth noting that the index has a fairly extreme lag. So like this week we got data from July, so it isn't necessarily actionable. I just think it's interesting to look at and examine. But what we saw was that in the month of July, the Case-Shiller index declined, and it was the first monthly decline that we've seen, or I should say the largest monthly decline we've seen since 2011, which was basically the bottom from the decline from 2008. So with and that was July, so it's now almost October. So I think mortgage rates are now up almost 1.5% since then. So I would say logically you would expect to see a continued decline in the Case-Shiller for coming months. Obviously, who knows what happens? I just think it was interesting and worth noting that we're just now starting to see the housing market potentially kind of roll over. In the stock market, it's kind of been, like Mitch alluded to with Bitcoin, it's kind of been a fairly sideways week. Obviously, yesterday was a pretty big down day. It was the worst down day we've had in 2 whole weeks or so, and we're kind of just flirting with those year-to-date lows on both the Nasdaq and the S&P. There seems to be remotely strong demand around those levels, and it seems like the market's sort of in a state of flux. And Bitcoin's in the same state as well, where it's if we're going to break down below these levels, it seems like it would be a pretty significant break and likely a retest of at least on the equity indexes of those 2020 highs, or I should say the February 2020 highs before that bear market there. But we're kind of flirting with these levels, and it seems like the market is unsure of where it wants to go. I mentioned in the newsletter that we're starting to see a breakdown of treasury yields and of the dollar. So I think that kind of gives the market a little bit of cushion to perform fairly well over the next couple of weeks if investors can push it in that direction. Obviously, who knows? I don't know. But I think we're sort of due for a quick snappy rally, kind of like what we saw in early September. So I have my eye on that, but I'm still kind of in the boat of personally, I believe that we could undercut those June lows. Obviously the S&P already has undercut those lows to an extent, but I think fairly significantly. I think we could do that. But obviously, I don't know. I don't have the magic crystal ball. But as I just mentioned, we're starting to see Treasury yields break down this week a little bit. I shouldn't even say the word breakdown. They're just kind of slightly falling. They fell into like the 8-day EMA. But it was Tuesday was the first red day for 2-year yields in like 3 weeks. So I thought that was a little bit significant, and it kind of led to that bounce we got earlier this week on Tuesday in the equity markets. And then we're also seeing the U.S. dollar currency index, or the DXY, start to break down a little bit this week too. Once again, it was 2 red days, so it's not anything too crazy to write home about, and just kind of went back to that 10-day EMA. And today we're back up about 0.5% or so. But I do think it's worth mentioning, and the reason I included that in the newsletter is just to just give people something to keep an eye on. I would say keep an eye on the 2-year, the 10-year, and the DXY. And if you can continue to see those all breaking down to an extent, it kind of gives a runway for the equity indexes and for Bitcoin to potentially go on a run. Aside from that, I just slightly mentioned at the end, we had PCE inflation numbers. So the Fed looks at PCE inflation. They obviously look at CPI inflation as well, but PCE inflation is the metric that the Fed likes to look at the most, which is very similar to CPI, except it's also including businesses and business expenses in their inflation numbers. So core PCE inflation came in at 4.9% for August, which was 20 basis points above July's number, and 20 basis points above analyst estimates for August, which I think is fairly significant. Worth noting that the Fed's inflation metric, if you will, is continuing to rise. From there, I included just a little bit about crypto exposed equities. Basically just gave a few names that I thought were standing out to me this week. I kind of think most of those stocks are just forming bear flags. From Bitcoin technical analysis, it's kind of what Mitch just talked about and what we talked about with the equities. We're starting to see, today prices are creeping up, but it's been a volatile week. We've just seen tons of reversals, and today it looks like we're forming another one. But it's kind of Bitcoin tries to break above this current wedge or this current range, and you see downside reversal, and then you try to break down below it, and then you get an upside reversal. So it's kind of just the market is saying it doesn't really know what it wants to do. Does it want to, or do the sellers have enough strength to break below those year-to-date lows, or do the buyers have enough strength to push bids higher and try to get away from those lows and get away from that 20K area? Obviously, I don't know. I think things look all right now. While we're coiling up, we've got a lot of good green buying volume of recent, but we're kind of near some potential resistance areas. You have the 50-day moving average declining overhead at around 20.6K at the moment. So I just think it's sort of just in a state of flux, and there isn't a ton to write home about with Bitcoin TA this week. But that is about all I wrote about. Obviously, there's going to be a little bit more in the newsletter and a little bit more explanation. So, I'd recommend going and checking it out.
That was great, Blake. And I think we've got a decent amount to unpack here around fiat currencies. Do you see, are you expecting U.S. bond yields to spike in the same way that the British pound bond yield spiked? Because what I hear is we're going to hike till something breaks, and it looks like something already broke in Europe. Do you think that's going to happen in America, and how soon?
How soon? I don't know. I think that's kind of a tough question. I think, it's always possible that you could potentially, have some catalyst that causes, yields to spike like they did over in Europe. But if you look at a chart of the 2-year, the 10-year, it's basically been straight up since July of 2020 or so. So we saw a near zero yield or 0.5% yield, which is now right around 3.7%. So yields have climbed extremely aggressively. And if you look at rate of change on these bonds, it's historically extremely significant. How quickly we've risen. Going from 0.5% to 4% in about 2 years or so is a really big jump. Especially if you're looking at it, from a percentage expected, a percentage of a percentage, right? If you're going from almost 0 to 4, it's a lot bigger than going from 4 to 8. So it's super interesting. I don't necessarily know. Is there going to be some catalyst that makes yields spike? Obviously, anything is possible. But I just think what happened this week was just kind of the culmination of a lot of stuff that is going on in Europe and with European monetary policy that does affect the U.S. to an extent, but a lot of it has to do with the energy crisis and the fact that the European Union gets a lot of their energy from Russia, and obviously you have all kinds of things going on over there and more sanctions today. So it's just a lot of pressure over there that we don't necessarily feel all of it in the U.S. So there could be some sort of monetary catalyst, some large event that could cause this cascade breakdown in bond prices, and which would obviously roll over into equities and probably Bitcoin. But what that is and when that could come, I think it's impossible to say.
It looks to me like it's the start of the dollar milkshake theory that people a lot smarter than myself talk about. They're already going to be forced to reverse course over there, and they're still in an inflationary environment. So that spells disaster for their fiat currencies. But it's not like ours is in a much greater position. It is relative to their fiat currencies, but we're still, we haven't really seen a good CPI print. And if our yields spike, like, yeah, they've been going up, but if they do like a real nasty spike upwards and the Fed does have to step in before CPI is down, like, that's not good for the dollar.
Yeah, I mean, I kind of think, I mean, the dollar's has been extremely strong of recent, and I don't necessarily think that it's because or I should say, it's probably not because the U.S. is doing so great. It's the fact that everyone else is doing so poor. And like the dollars is, or the Dixie is being compared to some of the largest currencies out there, right? The yuan, the yen, the pound, whatever, the euro, and you're seeing all these poor economic conditions around the world stemming from this energy crisis, and the U.S. produces a lot of its own energy, so the effects are maybe slightly less. Obviously, it's still a major issue. So you're seeing the dollar performing not great, but everything else is performing pretty bad. So we look like we're doing great, and I think in reality there's a lot of issues there too.
I agree, and this sort of makes me optimistic that we could see the great decoupling here soon. All the currencies are doing crap, all equities and any commodity is like doing crap, and I think people will soon realize that Bitcoin is the safe asset that you can hold in any situation. It can't be debased and it can't be tampered with.
Yeah, I definitely think it's possible. I think, especially from like a retail perspective, and I think maybe people in the UK might come around to this, depending on what's going to happen now with, their central bank. But it's this idea that there's a lot of fishiness going on across the world, and uncertainty, and Bitcoin can provide a level of certainty, self custodying your own wealth, that cannot be debased like that. I think from an institutional perspective, it's a little bit different because you're in an environment where everyone wants safety, and risk is, not what anybody is looking for. So, and there's a little bit of risk with Bitcoin, right? There's, obviously you have volatility risk, and then you have this sort of regulatory risk as well, where you don't really know what the government's going to do with it. Are they going to try to ban proof of work like they said they were 2 weeks ago? Whatever. So you have that sort of regulatory risk and volatility risk, and I think that is sort of what are scaring off That is what's sort of scaring off institutions at the moment. Trying to protect their margins and things like that. But I think that certainly from a retail perspective, it could potentially be a great advertisement for why you should hold something with a fixed supply that can be self-custodied.
Agreed. Yeah, at this point, retail, we've got nothing to lose. Joe, do you have any comments on this?
Yeah, Blake, I think that was fantastic. I like the stat that you mentioned that global bonds are on track for their worst year since 1949. I think it's been interesting how this year there's really been no place for investors to hide. You couldn't hold bonds, or if you did, you took a big loss there just because yields have been spiking like crazy. Equities have obviously gotten hammered hard, and obviously Bitcoin has gotten hammered as well. So there's really been no place to hide, and it'll be interesting to see, if wealth just keeps evaporating or when the tide will turn.
Yeah, agreed, totally.
No doubt. That's a good point to switch over to on-chain. So on-chain, what I'm saying is like it can't get much worse. This doesn't show what's going on in the macro, but like I said before, I'm really optimistic that we could get a decoupling here soon, just given how terrible fiat is doing, and all the problems with it are really coming to light. So first, when you look at the short-term holder realized price and long-term holder realized price, it is screaming to start buying right now. They've only crossed three previous times, all at bear market bottoms. So just looking at this, like I'm personally increasing the size of my dollar cost average. Not investment advice, but look at this chart and do with it what you will. Next is the hodl waves. So over 60% of the Bitcoin supply has not moved in over a year. That's a good sign that we're sort of in the bottom of the bear market. the holders are hodling. Nobody likes to sell at a loss, and you definitely won't see long-term holders selling at a loss. The only time long-term holders really sell is during the bull run. They might sell a little bit of their stack, never the whole thing, but they definitely do not sell in a bear market. So this much accumulation by long-term holders is really bullish. And then when you look at realized loss adjusted for market cap, I look at this and it makes me think we won't break the June lows. We always could, but you see a huge spike in realized losses, and that to me is like the big capitulation. I think it may have already happened. When you look at other past bear markets, you see typically one big spike in capitulation, and it looks like we've had that. Again, we could go lower, but I don't see it looking at this chart in particular. And then next, average coin dormancy. So this is coin days destroyed, but it takes out the volume metric. So it's just looking at the age of coins moving, essentially. Age being how long since the coin previously moved. And it's incredibly low right now. So again, that sort of ties into the hodl waves that only young coins are moving right now. Old coins are staying put. Long-term holders are not letting go. And this is what you see in the bottom of these bear markets. And at this point, this is more true now than in any other past bear market. Like, long-term holders are really convicted. No one's going to sell at a loss at 20K. That's just not happening. And that, to me, that I think that's building a floor. There's limited sell pressure on Bitcoin now at these range. Like, I don't know who's going to sell down here that hasn't already sold. And then when you look at the hodler net position change, they keep stacking. There's been like a handful of red days in the last year. So red days being like hodlers selling more than they add to their stacks. It's been basically all green for the last year, and it's been up big since we've been down in the 20K range. Liveliness, again, this shows a similar thing. This shows like long-term holders, their coins aging as liveliness goes down. So liveliness being like the amount of days since a coin last moved, essentially. And as this goes down, long-term holders their coins are aging. So the older they get, the less likely they are to be spent. When you look at realized cap hodl waves, which is similar to hodl waves, but except it's not looking at the percentage of coins belonging to different holding cohorts. It's looking at the realized cap belonging to different hodling cohorts. And 72% of the realized cap is in the hands of holders that have held for 6 months or longer. So basically what that means is a lot of the value, the realized value on the network is in long-term bags, and they're not going to sell at a loss. They're just not going to sell down here unless they're forced to. Anyone who would sell down here has already sold. When you look at this chart and you look how it's shaped in past bear markets, it's right there right now. So we'll be looking for this to sort of like roll over and go down, but it hasn't quite yet, but it's up there. So if we're not at the bottom, we're definitely near the bottom. The short to long-term realized value ratio. So it takes the ratio of the realized cap hodl wave from the 24-hour holders, so basically just traders, and then the realized cap hodl wave of the 6-month to 1 year cohort. So you can sort of think about 6 months is the on-chain cutoff from short-term to long-term holders. So these are essentially new long-term holders. They may have joined last bull run, and now they're like, oh, I'm not selling down here. So this ratio sort of it shows you the conviction of new holders, and the ratio is low right now. So that sort of signals we're near the bottom of the bear. It hasn't sort of flattened out though. That's sort of what you look for, and this metric tends to bottom before the price bottoms. And it doesn't look like it's bottom yet, so that could be an argument in favor that we haven't reached the lows yet. So I'm definitely going to be keeping an eye on this, but it is near bottoming, you can tell, but it doesn't appear to have formed a complete bottom yet. Entities net growth, it has dropped. So that's the growth rate of new entities, obviously coming on in the network, which, it's still positive, which means there's still new people joining the network, new entities, I should say, but the growth rate has slowed down tremendously, which is what you would look for in a bear market. You're not going to see as many new retail participants or participants in general, although we have seen a lot of institutions get involved recently. But retail, it's looking like their growth rate has slowed down. This metric, it's still up over time. So like the growth rate being slowed down now is not as, it's still higher than the growth rate was, in past bear markets. But it has taken a big spike here, which is, it's a good sign that we could be near the bottom. You're not going to see lots of new participants joining during a bear market. And then another thing I'm looking at is the futures open interest relative to the market cap, and this is up a lot right now. So that shows that there's a lot of people using leverage right now relative to the price, and that could trigger some kind of cascade event where let's say a bunch of people they're leveraged and their stop loss is at 18 or 17,000, and it all gets triggered at once. We could see a nasty wick down, but something like that, I wouldn't expect the price to last like low in those ranges for very long, but it could be a quick wick, like down to like touch 15K or something like that. That could be the really nasty capitulation that people are expecting. So when you look at the leverage right now, that gives credence to that idea. So it'll be interesting to see. I never recommend using leverage because if you've seen the chart, gold priced in Waymar marks, that's where we're at right now. Bitcoin is going to be the next global reserve asset. And if you're trying to leverage trade this against fiat currencies, no matter which way you're exposed, you could get wrecked. So I recommend not doing that.
I think that was really good coverage, Mitch. The charts that you posted in this thread tagged to the top of the space and in the newsletter are, super, super interesting. The one that I really think is interesting that I haven't seen until you posted this was how the entity's net growth metric has been like dropping like a rock. So I guess this is, more and more, Bitcoiners or more and more people are, joining the Bitcoin network, holding their own private keys, but it's slowing down. The rate of growth is slowing, at least over the last, few weeks. But I also think that, we've talked about this before, this bear market was kind of different where we actually saw a lot of new entities being created on the Bitcoin blockchain. I think it's because of, what happened with BlockFi, what happened with Celsius. We learned that, hey, like with Bitcoin, it's really important that you take, extreme ownership. You have that self responsibility to understand that, hey, maybe I shouldn't be lending out my Bitcoin to, very early stage, quote unquote, crypto institutions that, are doing relatively risky things with your Bitcoin. And I think this bear market, we saw, a lot of people recognize that, hey, I need to take self custody. And, maybe this drop in entities net growth is just kind of a sign that, near the end of the bear market, Bitcoin's dead. There's everyone that's blown up has already blown up potentially, and maybe we're primed to whenever the get this macro storm away from us, we'll be primed to take this to the next level.
Yeah, I think you're right, dude. I think a lot of people had the wake up call with the Celsius and the BlockFi, and that is sort of why we saw a bunch of new entities come on during that time. And that's just, if you don't hold your own private keys, you have to. Otherwise, Bitcoin's not going to be any different than the traditional fiat system. If you use a custodian, the incentive for them will always be to lend out more Bitcoin than they have in reserves. Bitcoin is great because even if a bunch of people, they keep their coins on exchanges and they rehypothecate. With banks, they could get a bailout if everybody comes. But with Bitcoin, if everybody comes for their Bitcoin, there's no bailing the custodian out. But you don't want to be the guy, that doesn't get all his Bitcoin back because he left it on the exchange. So take hold of your own private keys. Like, you have to. You absolutely have to. Joe, if you want to kickstart the mining conversation, the floor is yours.
Awesome. Yeah, will do. Three particular topics that I covered in the mining section of the newsletter this week. The first one is just monitoring mining difficulty. The past week, we actually saw a downward mining difficulty adjustment. So this means that it actually became easier for existing miners or remaining miners to mine more Bitcoin. They were mining literally more Bitcoin than they were, 2 weeks ago. I think with this downward difficulty adjustment, it wasn't major. It was, I think, like about down maybe 2% or something around that. So it wasn't a major downward difficulty adjustment. About 3 weeks ago, difficulty did hit a new all-time high, and the last all-time high that we saw in mining difficulty was back in May of this year. So we had this, very small minor capitulation this summer where a lot of hash rate was going off the network, and this was due for a couple of or a few reasons. One was just rigs that or old rigs were simply unprofitable at their current farm. They had relatively high energy costs, and they couldn't make it. And also a lot of miners were using the 2020 and 2021 bull market to take on like an extreme amount of leverage. And when the bear market set in, they got liquidated, or they couldn't make their interest payments and they had to default. So we saw this small minor capitulation this summer. Since then, we've seen difficulty start rising again, but we just saw this small downward correction. And in the newsletter, I talk about how I don't think this is going to be a new trend. Like, we're most likely not going to see another wave of minor capitulation unless the macro storm continues brewing and Bitcoin makes new lows. Then it's very reasonable to expect there would be another wave of minor capitulation. The second key topic that I covered in the newsletter was Bitcoin energy gravity. So this was a metric that Blockware intelligence team created, and it basically estimates the mean break-even electricity costs for modern mining rigs. And we define modern mining rigs as the average efficiency of rigs released in the last 2 years. So this metric, and there's a chart in the newsletter, this metric basically allows miners and Bitcoin holders or market participants to visualize miner operating profitability. So you can see during the bull run of 2013, early 2014, and the end of 2017 and 2020 and 2021, miners were extremely profitable. The break even electricity rates of miners in 2021 were like 40 cents per kilowatt hour, which is basically you could basically plug in your miner anywhere in the world, even at a retail electricity rate, and you'd be making a decent margin on that electricity. But now the energy gravity metric is back down to 9 cents, which basically means that a modern mining rig, their electricity break even cost is 9 cents per kilowatt hour, which is pretty competitive. That's not, it's lower than your retail electricity rate, and most mining farms are still below that, but it's getting to like a point where margins for miners are definitely very compressed, and historically that's been a sign that hey, there's either was a minor capitulation or there will be. And typically when minor capitulations do occur, that's near the end of Bitcoin bear markets, and potentially we have seen that this summer. The third final topic that I covered in the newsletter was the Compute North bankruptcy. So Compute North is one of North America's largest private Bitcoin mining hosting providers. They filed for bankruptcy last Thursday, and they have mining facilities in Texas, North Dakota, and Nebraska. And they have some of the largest mining clients in the world. One of their clients is Marathon Digital. That's Mara, traded on NASDAQ. So I think it's kind of an example of, hey, if you're going to mine Bitcoin, you need to have a very stable, trusted hosting provider. And Compute North is one of the best. So it makes sense to be very judicious when you're looking at partners for Bitcoin mining specifically. But yeah, I think it also shows that, hey, like when the bull market comes and you have the opportunity to raise additional capital, whether it's through equity or debt, you need to be careful. You don't want to get too leveraged when times are good, because in Bitcoin, it's an extremely volatile asset. As we all know, it goes through very extreme cycles. As we talked about macro, it's crazy times to be watching and monitoring financial markets. debt-based fiat systems are inherently unstable. They seem to be getting more and more unstable as the decades, come. And it's going to be interesting to see what happens over time. But yeah, it's Compute North was an interesting play, and it's a big shake up in the mining industry.
Yeah, dude, people who get liquidated down here are going to be kicking themselves in a few years. Right now, it's all about survival. If you can survive this bear market, these dark times, then you're gonna be doing great. We did a thread on that. I just pinned it up there on the nest. But when you look at your energy gravity model, and you see the break even electricity costs jump up to like 40 cents during the bull run. I'm sure there were a lot of miners who were tempted. They're trying to get online as fast as possible while the price is high, and they locked into some undesirable rates. And those high Bitcoin prices didn't last forever. And when you're locked into those rates and you raise money, you've got debt for new machines, and then the price goes down. You're not in a good spot. So you have to position yourself in a bull market to survive a bear market.
Yeah, and it's interesting, mining, ironically, it's an ironic situation where like you see the market and last year or late 2017 when rigs are very valuable, operating margins on those rigs are extremely high. That's when on paper you're like, wow, mining Bitcoin looks like a fantastic proposition. And even if you do buy the top when you're mining, as long as you hold to the next cycle, you're still probably going to be fine. But really, the best time to be buying spot Bitcoin and mining Bitcoin, when start mining Bitcoin, is when margins are compressed, rigs are a lot cheaper, because then when the next bull run comes, which is, in my opinion, is just a matter of time, you're going to get your margins are going to start expanding, and the rig that you actually bought is going to actually be worth more than you paid for it. So it's kind of like a win-win situation when you look at it that way.
Yeah, for sure. And the price is going to rip up faster than other difficulty can get online, because that requires, the price can move in an instant, but plugging in machines at scale, that's work, and that takes time. So if you're online now, if you buy a machine now while it's cheap, you're going to do really well when the bull run comes. You just have to survive the bear.
Yeah, exactly. We did a podcast with Adam O from Upstream Data and we talked a lot about this topic, kind of at the point where like ASICs are commoditizing. So it's not like Bitmain can come out with a new ASIC and all of a sudden your old ASIC is completely obsolete, and you just kind of take out your old ASIC and you put in your new ASIC and your hosting center or your data center. Now it's like these rigs if price goes to $100,000, that's a lot of rigs that are going to have to get plugged in. That's a lot of data centers that are going to have to be built out. That's a lot of rigs that are going to have to be manufactured. That's a lot of energy that's going to be consumed, and that is just not going to happen overnight at all. We saw how difficult it was for hash rate just to climb all of last year. I mean, it's still, I don't know the exact numbers, but it takes hash rate a significant amount of time to double now, and price can go from 20,000 to 40,000 in a couple months. But for hash rate to go from 200 exahash to 400 exahash, that's not going to be able to that's something that's not going to happen overnight.
No doubt. And something that's cool too is the way the infrastructure is being out to capitalize wasted energy, and the way machines they're only getting marginally better, like you said. So there's always going to be someone willing to buy your machine. Even S9s now are still plugged in. Like the cheapest energy, the less efficient machines are going to funnel to the cheapest sources of energy. So your rig will always have some sort of exit liquidity if you want to upgrade or just get out of mining in general. So they're not going to be worthless at all. Like, and in the long run, that's super bullish for hash rate, of course, because all these machines are going to get them. They're going to find a home somewhere.
Yeah, and it's also, I think, it's great for the network. Like, Bitcoin miners are out all over the world searching for cheap wasted energy, and if you have access to cheap wasted energy that's close to zero, and you can buy an ASIC, a machine that literally converts energy into sats, into Bitcoin, there's going to be entrepreneurs out there that do that. Now, the great example of this is like the natural gas flaring or methane flaring, capping that and using that to plug it into a generator and turn on your mining rigs. It's also not very scalable, which is, in a way, is kind of a good thing, because it promotes the idea that, hey, like, these older generation rigs are going to just get pushed out all over the world in the smallest nooks and crannies of the energy markets, and the network is, or at least the mining network, is going to be very decentralized and very geographically distributed.
That's awesome. Yeah, I've never thought about it like that, but yeah, that's great. I think we'll probably wrap up here. If you missed the conversation but you want to hear it again, it's been recorded, so it'll be here on Twitter, but it'll also be up on YouTube in a day or two. And on YouTube we'll have all the charts and stuff that we've been discussing. Make sure to check out the newsletter. If you are interested in mining, I know we just sort of really hyped up mining right now, but it is actually like a really great time to get in and buy a rig. So get in contact with us. We can get you hooked up. But I think that'll do it for today. Thank you, everybody, for listening. Joe, Blake, you want to say your goodbyes?
Yeah, thanks, everybody. If you have any questions, DMs are open about Bitcoin, mining, macro markets, anything. We're happy to help. But thanks, everybody.
Yep. Couldn't say it better. Have a great weekend, everyone.